What does preferred equity mean when it comes to multifamily real estate investing? In this video, I'm going to walk you through the top part of the capital stack and explain why preferred equity is a good thing when you're investing in multifamily real estate. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and the author of the real estate book, Sell for More. So let's get right into it and talk about preferred equity and how it relates to investing in the capital stack. And if you're unsure what a capital stack is, I'll put a link right up here to the video I did explaining the whole capital stack. Because today, we're just talking about the top part, so the equity portion. So we have debt down here, so check out the other video. But at the top of the stack, we have common equity, and then we have preferred equity. I'll just say pref equity right below it. Now, as we know, or as you will know after you watch the capital stack video, we know that the capital stack is paid from the ground up, let's say when a property is sold. So we have debt, which is static down here. It's the lowest risk because it gets paid first. And then as we move up the stack, we have the equity portion, so preferred equity, then common equity. This is the equity portion is where you participate in the upside. It carries more risk because it's paid later on up the stack. But if you are bringing your capital, bringing your money into a real estate syndication, you will be assigned most likely what's called preferred equity. Now, what is the difference between common equity and preferred equity? Well, we just look at the name. Preferred equity is given preference over common equity. And what does preference mean? Well, let's talk about preferred returns. So a preferred return is where the preferred equity must meet a certain threshold in terms of the return they are receiving before the common equity is able to participate in the profits. So let's break it down like this. Let's say the preferred return is 7%, which I could call very common these days in a real estate syndication. So a preferred return of 7%. So what this means is that the preferred equity shareholders, so the limited partners in a deal, and if you're not sure what a limited partner is or a general partner, I'll put a link right up here to my real estate syndication breakdown video. So that would be really helpful for you. So we have a preferred return of 7%. So this means that all the preferred equity shareholders must receive 7% on their money before the common equity, so the general partners in the syndication, are able to participate in the profits. The same thing goes when the property is sold. Again, the preferred equity shareholders must meet those thresholds. They must be given that return before the common equity, the general partners, are able to participate. Now, why is this a good thing if you're a real estate investor? Well, it's all about what's called alignment of interest. So generally speaking, the GPs, the general partners, person actually running the deal, they are holding common equity shares. And then the passive investors, the LPs bringing their capital, are assigned preferred equity shares. Why is this a good thing? Well, in order for the people running the deal to get paid to share in the profits, the limited partners, the people bringing the money into the equation, must meet these promised returns, the preferred returns that they were promised. So in terms of alignment of interest, in order for the person who's running the deal to get paid, they have to actually perform on the deal and pay these limited partners, these preferred equity shareholders, what they were really promised at the outset. This is a really good thing because if I'm going out as a GP and offering a 7% preferred return and I don't perform on the deal and nobody's making money, I should not be getting paid because I'm not doing my job. So when it comes to alignment of interests, this preferred equity is a great way to make sure that the person running the deal is performing as they should because they only get to participate in the profits after the preferred equity shareholders have achieved their preferred return. So I really hope you found this video useful as it relates to preferred equity and how it lines up in the capital stack. So if you're interested in learning more about the real estate deals I'm currently doing, head on over to callseth.com and set up a quick 20-minute phone call with me. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think. And until next time, happy investing.